During the COVID-19 pandemic, countries worldwide put economic activity on hold to prevent the virus from spreading. The UK's recovery from the damage caused by the COVID pandemic lagged behind other big economies in the first 3 months of 2021. Today, we will see the UK economy recovering dramatically worse from COVID than the EU and the US. Stay tuned till the end of this video to understand everything about the current scenario of the economic position in the UK. The Bank of England governor has stated that the UK economy is recovering from the COVID-19 pandemic far worse than the Eurozone and the US. Andrew Bailey, the governor of the Bank of England, told MPs at a Treasury Select Committee hearing that there was a dramatic and stark difference in economic performance. Mr. Bailey stated that the UK's GDP had not yet recovered to its pre-pandemic levels and was 0.7% lower. He contrasted this with the Eurozone, whose economy is now 2.1% larger than in 2019. He said that the US economy had grown even more, with GDP now 4.2% higher than it was at the start of the pandemic. During the COVID-19 pandemic, countries worldwide put economic activity on hold to prevent the virus from spreading. Most economies recovered quickly after reopening, but the UK did not fare as well as its neighbors. Mr. Bailey had told the MPs that he's afraid as he's about to tell a bad story. The level of UK GDP now versus the pre-COVID level compared to other economies is probably negative 0.7%. In other words, the economy is smaller in terms of GDP than it was at the end of 2019. The Eurozone is up 2.1 points, while the US is up 4.2 points, according to the most recent data. It's a significant difference. He believes that several factors are to blame, including the approach taken towards energy prices and fiscal support, as the United States has received substantial financial assistance and is in a very different economic position. There are probably a lot of factors contributing to it, but it's pretty striking. Mr. Bailey was speaking on the same day that the Office for National Statistics reported that rising food and energy prices had pushed UK inflation to a 40-year high of 11.1%. In the first 3 months of 2021, the UK's recovery from the COVID pandemic lagged behind that of other major economies. According to the Organization for Economic Cooperation and Development, or the OECD, economic output was 8.7% lower than it was before the pandemic at the end of 2019. Overall, the G20 group of major economies' economic output increased, led by India, Turkey, and China. However, the majority of others, including Italy, Germany, and the EU as a whole, shrank. The gross domestic product, or GDP, or economic output of a country, measures how well or poorly an economy is performing. According to the OECD, GDP in the G20 region will return to pre-pandemic levels in the first quarter of 2021, with large differences between countries. Big variations in how the economies are recovering from the pandemic. Overall, the G20 expanded slightly compared to the final 3 months of 2019 before the COVID pandemic caused mass lockdowns and economic disruption. The United Kingdom and Italy experienced the most significant declines from pre-pandemic GDP levels, falling 8.7% and 6.4% respectively, while Germany, France, the Eurozone, and the European Union all experienced declines of more than 4%. In the first 3 months of this year, the G20 countries grew by 3.4% year-on-year. According to the OECD, China, which was affected by COVID earlier than other countries, had the highest annual growth rate of 18.3%, while the UK had the lowest annual growth rate of -6.1%. The OECD predicted last month that the UK economy's recovery from the pandemic would be stronger than previously anticipated. It predicted that the UK would grow at a rate of 7.2% in 2021, up from 5.1% in March, making it the fastest among the large rich countries. It also increased its forecast for global growth this year to 5.8%, up from 4.2% in December. It did, however, warn that growth would not be distributed evenly. The global economy is slowly recovering, but there's still a lot of uncertainty about the future, and the picture, shown before, varies greatly by region. It's easy to see why. Although the pandemic has ravaged countries worldwide in the last year, there have been significant differences in the timing of outbreaks, as well as the speed and nature of national responses. The progress of vaccination programs, particularly in wealthier countries, is now providing grounds for optimism that a return to normalcy isn't far away. However, this must be balanced against concerns about the potential impact of new virus variants. The European Central Bank's decision today to maintain its COVID-related economic stimulus program, despite raising its forecast for Eurozone growth and inflation, reflects this uncertainty. If the past year has taught us anything, it's that predicting the path of the pandemic is anything but simple, and the road to recovery is unlikely to be easy. The pandemic and Brexit have both had an impact on the UK economy in the last year. Furthermore, the United Kingdom has a legally binding target of becoming carbon neutral by 2050, which will necessitate significant structural changes in the economy. Alex Chapman is a senior researcher at the UK-based New Economics Foundation Brink, and was asked to forecast where he believes the UK economy will go in the next 2 years. The pandemic marked the end of a decade of public economic recession in the United Kingdom, which had a particularly low level of state benefits and other social protections in comparison to the majority of their European neighbors. Adult education participation is also at a 3-decade low, and economic growth has slowed as a result of Brexit. So, in many ways, they are unprepared for the structural changes that are required. The United Kingdom is now committed to transitioning to a zero-carbon economy. There's still debate about how quickly that needs to happen and how deep the structural change involved will be, but the country has committed to it in legislation, so change is on the way. The existence of historically low interest rates, which has given the government a huge amount of breathing room in terms of being able to invest and borrow, puts them in a slightly better position. Brexit and drop in workforce harming economic recovery. Britain is performing worse economically than its competitors as a result of Brexit and a significant drop in workforce size since the COVID pandemic, according to the Governor of the Bank of England. Andrew Bailey said a combination of economic challenges had prevented the economy from recovering to pre-pandemic levels, while also warning that it would take time for the government to repair damage to Britain's international reputation caused by former Prime Minister Liz Truss's disastrous mini-budget. It came as 11.1% inflation, the highest rate since October of 1981. This increased pressure on the bank to keep raising interest rates. On the eve of the Chancellor's autumn statement, the Governor of the Bank of England told MPs on the Commons Treasury Committee that the UK GDP remained about 0.7% below its pre-COVID level, compared to much stronger recoveries in the Eurozone and the US, where GDP levels had recovered to about 2.1% and 4.2% above pre-pandemic levels, respectively. When asked if Brexit was a factor in the country's poor performance, he stated that there is an effect of leaving the EU, including a long-run downshift in productivity. Mr. Bailey said it's not an impact that has surprised them. As a public official, he is neutral on Brexit in general, but he's not neutral in saying that they are the most likely economic consequences. In a disturbing assessment of the mini-budget, Bailey declared that the UK had damaged its reputation internationally as a result of what happened. Threadneedle Street was forced to intervene with an emergency bond-buying scheme to calm the turmoil in government debt markets after then-Chancellor Kwasi Kwarteng announced nearly £50 billion in unfunded tax cuts. Bailey stated that the meltdown was discussed by world leaders and central bank governors at the International Monetary Fund's annual meeting in Washington. He suggested that bond market investors had been watching Kwarteng's mini-budget speech unfold in near disbelief, and that the former chancellor's plan to abolish the 45p additional rate of income tax had captivated their interest in particular. From an economic standpoint, it's not the most important thing. However, as market participants put it to them, is that the right thing to do in that situation? Households are under intense pressure from inflation, which rose to 11.1% in October, owing to rising energy costs and the cost of a weekly shop. The annual inflation rate rose a percentage point last month to 10.1%, according to data from the Office for National Statistics. The British economy took the first steps towards a potentially long recession in the 3 months to September, according to official figures, with a 0.2% decline in GDP in the third quarter. A second consecutive decline in the fourth quarter would be considered a recession. In response to questions from the Treasury Committee, Bailey and 3 other members of the bank's Monetary Policy Committee, or MPC, said that a sharp decline in the size of the workforce since COVID was one of the reasons the country was being held back.